Janet Yellen came out, I believe this was late last week, and said, listen, you're overreacting to the last CPI data because when you look at the bigger picture, inflation is coming down just as the Fed wants it to. And the anticipation of quick rate cuts, I believe, was a wishtimate rather than a guesstimate or estimate.
Gary Wagner is back. He is the editor of thegoldforecast.com. What will happen to gold this year during the first rate cut cycle of many years? And we'll be talking about the dollar as well and his inflation outlook. Gary, lots to cover today. Thank you for being here.
Great to be here as always. Thanks, David.
We spoke about a month and a half ago in early January. Gold has been trading range bound since then. We'll touch on the technicals of gold and your outlook in just a bit, but let's talk about the economy and what the Fed may be thinking at this point in time. All we can do is speculate because neither of us are Jerome Powell. Now, the markets are pricing in not a 92% chance of no cut or no change in the rate at all by March. This has been a tremendous change in sentiment over the last 6 weeks, as initially there was a higher probability of a cut by March, but now it's looking like that's no longer the case. What fundamentally changed over the last 6 weeks, Gary, that would prompt the markets, specifically the Fed Watch tool, to favor no cut by March?
Well, I think what occurred last week when the CPI report for January came out. It came out fractionally hotter than expected, a tenth of a percent, but nonetheless, that is the point in time in which gold, which had been in a triangle pattern, meaning a series of lower highs and higher lows, broke to the downside and then made the low at about 1980, 1990 in that area, and then subsequently began to rise over the last 4 days. But I think the primary reason we saw it break out was the CPI data, because that brought in the fact that inflation was still running hot and maybe they didn't have as much of a handle on it. They tend to be as conservative as possible while timing it properly. And that's threading a needle. And up till now, they've been doing a good job because employment numbers have been strong, the economy's been strong, and yet inflation has been cooling for the most part.
Yeah, you're right. Inflation has been cooling. And if you take a look at the last BLS CPI report that came out, like you mentioned, it was still 3.1%, which, by the way, is lower than December's 3.4%. It's just that, like you said, the expectations were for it to go down even more. Why do you think there's this expectation of such lower inflation right now? Again, it overshot according to expectations, which is what moved the markets a lot that day. The stock markets went down, as you know. So I'm just wondering why people think inflation should be a lot lower than it actually is.
Well, my question is, did it really overshoot it? In other words, it only came in a tenth of a percent different from what the forecasts or estimates were. And it is absolutely contracting, declining, inflationary pressures are going down. There's troublesome areas like housing. Energy costs went down, but housing went up. But Janet Yellen came out, I believe this was late last week, and said, listen, you're overreacting to the last CPI data because when you look at the bigger picture, inflation is coming down just as the Fed wants it to. And the anticipation of quick rate cuts, I believe, was a wishtimate rather than a guesstimate or estimate. In other words, market participants are hoping that rates are cut sooner than later, because once Powell in December announced the pivot is going to happen next year, market participants, for the most part, want the best scenario, which is cuts as soon as possible. And the Fed, of course, continues to say the data is right. We want more of it.
I get, well, anything's possible at this point, but what's the likelihood of inflation shooting up to the upside unexpectedly? What would be the drivers of higher than expected inflation going forward, Gary, if there were to be any?
The main thing that would be on my radar is the troublesome area, meaning the Red Sea. the attacks on the military and the attacks on merchant ships, that seems to have either come out of the news cycle or slowed down after the military strikes that followed. That is the one troublesome area, of course, because a large percentage of Europe depends on that shipping lane to get their goods. If they have to go around it, it is going to raise costs, at least in Europe. We're not as bound by that. But that would really be the one thing that could cause inflation to reverse its course temporarily.
If, let's say, a conflict globally does break out, I'm not saying it has to be from the Red Sea, although it could be, the Fed would be in a precarious position because, on the one hand, conflict is never great for the economy, which would probably entice them to lower rates. But on the other hand, like you said, it could, it could boost inflation, and so they have to watch the data to see what would happen. In that scenario, what do you think they would prioritize? Economic growth or inflation?
I would think inflation. Their primary goal out of their dual mandate, which is full or maximum employment and a level of inflation that is acceptable, is unbalanced right now. They're focusing almost solely on getting inflation nearer to the 2% target. When you consider that in June of 2021, I believe, I might be wrong about the year, was at 9.1%. And that's 1 month after the first quarter percent rate hike in March of 2022 is the year I'm referring to. So it went from 9.1% down to 3. They've gotten control of that. The only thing would be a black swan event, and a black swan event in terms of gold pricing, though, would shift the momentum to the upside because it would act as a safe haven. Right now, it's waiting for cuts, so it's more favorable. And the other thing to look at is the equities markets, because as they have been moving to new highs, especially the S&P, that has come down since. But when you have a very strong risk-on scenario, traders tend to draw their preference in terms of allocation of funds into equities rather than safe haven plays such as the dollar or gold.
The CME Fed Watch tool is pricing in a significant chance of a cut by June. In fact, that is the first month in their timeline in which a significant cut is priced in. Do you agree with that timeline?
Well, the timeline, according to the FedWatch tool, is 39% probability of a cut in May,
Yeah.
and then 77.5 in June. So I think the assessment is right as long as the data continues to show that inflation at least is stabilized, is not strongly ticking up. And I think that that's the most likely scenario unless some sort of unexpected event occurs. June is really what they've been calling for, and I think that market participants are now have factored that into the market, and that's why we saw the pressure in gold breaking it down after the CPI data came out last week, and now it's moving back to nearly where it was prior to the report being released.
Okay. Let's turn to some gold charts now, Gary. We
Sure.
have uh we have a price chart that has not been breaking out significantly either to the downside or upside. More or less, it's been consolidating over the last, I would say, month and a half. How
Sure.
would you evaluate this pattern?
Well, let's go ahead and pull up a chart, and once we have it up, I'll talk to you about it. This is actually spot gold, and what we're looking at is from the lows in October that came in, just above 1,800 an ounce, up to the record high, which if you didn't look hard, if you blinked, you missed it because it hit a high on Friday, and then by Sunday had not only taken away the 2,100 plus high, but moved to a ridiculous low of around 2024, a huge move over the weekend. At that point, we had a series of higher lows and lower highs. So that's why you see on this chart, these two lines, support and then resistance up here. and you can see the series of lower highs and higher lows. Now, typically in a compression triangle, it will break to the prevalent trend direction, which in this case would have been up, but it did not. It actually broke to the downside. That's this large red candle here. We then followed that by a doji candle that came in on the 14th. And now we've had 4 consecutive days of green candles, meaning higher highs, higher lows, higher closes, which has been a really, really strong reevaluation of the market and recovery in gold since that fall. So that's what we're seeing in this chart.
Are you surprised at all that gold has not broken down significantly, given how strong the equity markets have performed over the last, well, since the beginning of the year?
Well, I'm not that surprised that it's held up well because the likelihood of more geopolitical tension reemerging, so to speak, is pretty high. Both wars are still going on in the Middle East and Russia and Ukraine, of course. They go into the news cycle and out of the news cycle. Right now, they're out of the news cycle. And so the fact is that they still are highly supportive, whether or not the news is talking about it. Traders are aware that it's a tinderbox, and at any moment, things could change dramatically. And that's why I believe gold has held up so well.
Now, okay. Gold has historically been, let's revisit the functions of gold. It's performed as what primarily? An inflation hedge, a hedge against volatility, or a hedge against risk, or all of the above?
In some ways, all of the above. The key that I like to say when we look at gold in terms of a hedge against inflation is the buying power of gold has remained consistent really for the last 100 years plus. What you could do with an ounce of gold in terms of purchasing power has not changed dramatically, but the dollar has. And there's a ton of examples, but the fact of the matter is that it does have a correlation between, excuse me, there is a correlation between the buying power of gold and how that reacts over time. So it is a hedge against inflation. Secondly, it continues and will always be a safe haven asset in times of geopolitical tension. And we're definitely seeing that in different parts of the world. And that hasn't changed.
The significance of $2,000 an ounce can't be understated. It's been hovering around this range for quite some time. It's had trouble breaking out above and maintaining above $2,000 an ounce. Would you consider this a floor or a ceiling?
I would definitely look at $2,000 as a floor in which one of the slats was broken and kind of somebody fell through, but that it quickly went back. In other words, the recent dip took it to a low of about 1980, but now it's sitting well above that at what 2020, 2030. So I believe major support continues to be $2,000 per ounce rather than resistance as it was months ago prior to the October rally.
Gary, let's zoom. I don't know if we can zoom out a bit, but if we take a longer term perspective and zoom out into
Absolutely.
2020, can you go back to 2020?
Yeah, let's go ahead. And what I'm going to do is convert this to a weekly and then
Yeah. And the reason I'm asking you to do this, Gary, is I've noticed that gold has over the last, well, 3, 4 years or so, consistently made higher lows and higher highs. Um,
Okay.
I don't know if this pattern is indicative of a longer term bull rally or it's just a big later or the latter phases of what was a bull rally. How would you interpret this longer term trend?
Well, when I look at the longest term trend, I look at the first high that occurred in the middle of 2011 that was above 1900. From there, it fluctuated between 1500 and 1800 and broke hard. And by 2015, the end of it, it hit a low of 1020, I believe. From there, it's really been up. And you can see that when we look at this chart. Let me just compress it so that it shows the lows. And let's make that full screen for our viewers. And I think that's what you were asking for, this kind of a long-term view. And so what we see is right over here, 2016, the beginning, this is the actual low. From there, when you start looking at higher lows, you get them consistently until we kind of flatlined for a year or so, and also higher highs up till the recent high. So we've had three tops, one in 2020, 2021, as well as this year.
Okay. Would the technicals indicate a top or an extension towards a top?
That's an interesting question. I think that that's going to be contingent on how the fundamentals play out, specifically inflation.
Okay.
If it continues to contract and actually exceeds expectations, that would entice the Fed to maybe cut rates in May rather than June. I think that we could see a higher movement. We know where the ceiling is, and that's the high that was made in terms of the date back in November, beginning of December, above $2,100 per ounce. That's the brass ring, so to speak.
Mm-hmm.
And I don't really see that resistance getting played out easily. But between 2000 and just above 2100 is the range I think it's going to continue to play in, with the bias to the upside if inflation doesn't go wildly out of hand, which I don't think it will.
I think some investors are concerned about whether or not gold could see a repeat of 2012 to 2015. Recall that gold peaked in 2011 back then. Well, it's peaked back then. And after 2012, it corrected all the way back down to a low of, 1077, almost $1,100 in 2016. So it was a sharp decline and then a multi-year kind of consolidation around those levels before 2020 happened. Now, I'm not saying the economy is exactly the same as in 2012, but certainly if you take a look at inflation, the rate of inflation is actually similar. Back then, the rate of inflation was relatively low, between 2 to 3%, relatively steady. There wasn't any sort of economic contraction at the time. It was steady growth,
Mm-hmm.
low single digit GDP growth. Not a lot of geopolitical tensions back then, but certainly we can make some parallels to today just on paper. So I think what investors would like to know is whether or not that is a possibility for gold to correct all the way back down to, by the order of another 50%, given how similar some of the stats look on paper, Gary.
I think that in terms of probabilities, that is unlikely. We've seen it retrace down to the low 1800s pre the October rally. So that to me is the lower end of the range. If we broke below, say 2000, and we had a sharp correction, I don't see it moving below 1800. And so we've been there a few months ago. I don't see a correction back to 1600, which is what occurred. I've really compressed this chart, but if we look at October 2022, we had these lows come in at around 1600. I don't think the probability is high of that happening again, but we just recently retraced to just above 1800 and then recovered very quickly back from October to current pricing.
Right. Let's take a look at the US dollar before we clear. Actually, no, before that, let's get your outlook for gold then. So given what we've talked about, what do you think is a reasonable extension in the next couple of months?
Well, my prediction for my outlook prior to everything happening, and this was at the end of last year, was 2200 to 2300. I
Yes.
think that throughout this year, it's still possible once rate cuts begin. If they occur early, we could see that tested. We need to retest, obviously, the all-time record highs just above 2100. But if the Federal Reserve is more aggressive in rate cuts, in other words, we're focusing on the timing. But if we look back to the dot plot that was released in December of last year, they were looking for 0.75% in terms of cuts this year, and then continued cuts throughout 25 and 26, taking or normalizing interest rates somewhere around 3 to 3.5%. That is the incentive that's going to move gold higher if in fact it does break back above 2100. So over the next couple of months, short term, it's really going to be, we're going to look at the minutes, and then we don't really have an FOMC meeting till March. And as you correctly pointed out, there's almost a nil chance of a rate cut then, a small chance, say 40% in May, and the majority are looking at June. So depending on how that plays out, if they cut in May, we could see the moves quicker. If they wait till June, I think we could see sideways action, but I do believe inevitably we'll see $2,200 gold by the end of the year.
Yes. It just occurred to me that not always, but most of the time, the US 10-year yield holds a negative correlation with gold. I think that makes sense fundamentally, but certainly it would be important to get your outlook on yields because it affects gold. Do you see the 10-year, in particular the 10-year, continuing to move up, Gary?
I think that the way inflation has been running, it's still declining, even with a hotter reading in January. Like you said, it's still in a good space when we compare it to December. The longer term trend shows a decline in inflation that's been consistent since the rate cuts began March 2022. So we're now running into what, almost 2 years since they began a very aggressive policy, 11 consecutive rate hikes, then a series of pauses. Once cuts begin, it's going to be an incentive to move into safe haven, because right now the yields are so attractive, it really takes away the allure of gold, because it's a guaranteed yield of what, 4 or 5%. And that's significantly different than what we saw in 2020, when if you got a 0.5% yield, you were doing good. So
Right.
it's a different era, so to speak.
Right. Okay. Gary, let's move on to talk about the US dollar, the DXY.
Sure.
Again, a very important variable when it comes to looking at the gold price because they've been inversely correlated in the past. Um, I'll let you talk about this chart that you just pulled up and what this pattern shows.
Well, really, I'm going to compress it just a little bit. We had these highs of about 107 that began October 2023 to, again, October 23, and then it dropped just to about 100, and that's where the floor came in. So if we look at where the dollar has gone from, let's say, December up until it peaked, which was very recent, it hit a high February 13th, I believe. And then we've seen it cycle down for the last 5 consecutive days. This is a daily chart. So continued dollar weakness is obviously going to have a strong bullish influence on gold prices. And we've seen that. We've seen 4 consecutive higher closes in gold. We've seen 5, not consecutive, but 5 days of the dollar trending lower. So we're getting the type of correlation we typically look for, which is dollar weakness leads to gold strength.
Right. So you're anticipating that the dollar to continue to weaken later this year.
I believe that it could. The floor is really 103. Currently, it's at 103.98, call it so 104. So if it does continue to decline on a technical basis, it doesn't really have any strong support for a full percentage till 103. So if we do get that 1% decline, that's going to really be very bullish for gold.
Okay. The last thing I want to bring up is risk assets and how that would affect gold. You mentioned already your outlook on gold. I wonder how that um, relates to your outlook on risk assets, in particular certain equities and Bitcoin. Certainly, if there's a lot of risk appetite, we may see diminished interest in safe haven assets like gold. But I'll let you comment on that. Bitcoin has seen tremendous gains this year.
Hmm.
I know you and your son has worked in the technicals, so I'm just curious to get your take on whether or not $50,000 is a critical point for Bitcoin to break any higher.
Right. Let me go ahead and pull a Bitcoin chart up. Give me 1 second, please.
Yeah.
In terms of Bitcoin, it definitely peaked at around 52,000 and now is trading sideways. Let me pull that up. Well, let's go for this one. So what we're looking at right now is a weekly Bitcoin chart, and you can see that it hit this top. I want to convert. Oh, it's a monthly. Let's go to a daily. Give me 1 second here. All right, now we can see if you take a look at these recent lows that came in about 40,000, a really huge rally, taking it up to highs of about 52,000. And then we look at the last, say, 5 trading days, you can see sideways trading action. In other words, in candlesticks, what we look for in a consolidating market is alternating colors, red candles, green candles. And that's what we've seen. It's unlike what we have seen where we had these series of higher highs that was significant really from the 23rd of January up till the high recently, which was the 15th of this month. And also, if we convert this chart into a Henkinashi, you can see how this smooths out that rally. And it should be up on the screen now. But let's go ahead and go full screen. What you can see is this tremendous candle size that occurred really from the first week in February up to these highs at around 52. And even though we're not getting alternating candle color, we're getting much smaller candles with upper and lower wicks. So in terms of a Henkinashi chart, it's showing consolidation, and candlesticks are showing consolidation or a potential either short-term top, meaning it will trade sideways for a while, or an actual correction are the two scenarios according to the studies of Joseph, my son, of course, who has been following Bitcoin very, very closely.
Very good. Ultimately, do you think Bitcoin could outperform gold this year?
Absolutely. Bitcoin, when you look at
I mean, let me rephrase that. It already
okay,
has, but I'm just extending this to towards the end of the year. Yes.
in terms of percentage gains, it could easily have greater gains, considering even if gold runs to 2250 by year end, Bitcoin has the ability in terms of the short-term resistance level going from 52 to about 58,000. And I think that that would be a much larger percentage gain than gold moving from current pricing around 2030 to 2200.
Okay, Gary, I appreciate your analysis. Tell us where we can find more about your work, learn more from you.
Thanks for asking. Thegoldforecast.com, of course, is our website. On YouTube, we do publish all of our archive videos, but on Fridays, we actually release the same report that our premium subscribers get. So those interested in what I'm looking at in real time, check out YouTube on Fridays for our weekend review. That's the best place to really get my most current read on the market.
All right. Well, it's that we're going to the movies, and I choose Gary every time. So on a Friday night. Thank you very much, Gary, for your time. I'll see you next time.
Thanks so much for having me, David.
Thank you for watching. Don't forget to subscribe and like this video.